2022. August 2022. And this was question number what? This was question number 4. Question number 4. So if you are here, please confirm. If you have the question with you, just confirm. Just confirm. Just confirm. Just confirm whether you have the question. Yes, confirmed by Elizabeth. Confirmed by Patrice. Okay, so what are we told as far as this question here is concerned? What are we told here? So the question is, Tagga Limited is a private company, private limited liability company operating in telecommunication industry. The company has suffered successive trading losses for a number of years, largely due to stiff competition. Yes, that's what I'm recording. Largely due to stiff competition and a sharp decline in the revenue. So we are told the directors of the company, who are also the main shareholders, agreed to restructure the company by transferring it to a new company to be named 𝐎𝐍𝐻 Limited. So automatically, this is an external reconstruction because this company, which is called Tagga, we are told it will be restructured by transferring its business operation assets and liabilities to a new company, which is called 𝐎𝐍𝐻 Limited. So then you're told the statement of financial position of Tagga Limited as at 30th of June 2022 was set out below. So we're given the statement of financial position of that company before the reconstruction. We have the non-current asset, current asset, we have equity, non-current liabilities, and current liabilities. Then we have additional information number 1 or the note number 9. And basically, if we go through this particular note here, whatever you're given in note 1, note up to note 9, and basically you compare with the other question which we did, you'll be able to see the notes are almost the same. The notes are almost the same because I say these questions for external reconstruction, they are the same. So the examiner will just try to change very few items, but essentially the questions are the same. So what are we required to do here? Part A, we are required to prepare the following ledger account to close off the books of Tagga Limited. Roman 1, the realization account. Roman 2, ordinary shareholders salary members account. Roman 3, the preference shareholder salary members account. And then part B, we are required to make the journal entries in the books of account of 𝐎𝐍𝐻 Limited to record the acquisition of Tagga. If you can remember the other question which we did, the examiner was not requiring the student to make those journal entries. And then part C, we are required to prepare the opening statement of financial position of this company, of the new company, as at 1st July 2022. So remember what we say is that once you come across such a question for external reconstruction, basically I think I talked about a number of steps which you need to follow. Number 1, we said compute the purchase consideration. Compute the purchase consideration, which the new company is supposed to pay the shareholders and the financials of the old company. Number 2, close off the books of account, books of what? Of accounts of the old or the selling company. Of the old or the selling what? Company. Now, after doing that, like this particular question here, you have now to proceed and you make the journal entries. The journal entries to do what? To open the books of account, to open the books of accounts of the new company. The new what? A company. And then finally, you prepare the statement of financial position equally for the new what? A company. Essentially, these are the steps you should follow. But we said in an examination setup, I will not advise you to compute this because if you can remember the question we did yesterday, I think you can be able to recall how computation of the purchase consideration was demanding and also it is time consuming. So therefore, if you happen to come across this question in an examination setup, avoid computing this. Even without having computed that, you'll be able to get good marks, basically over 15 marks, without having computed that purchase consideration. So what we need to do basically, we will go straight to closing of the books of account of the selling company, basically by preparing the relevant ledger account. So those are the ledger accounts we require to prepare in Roman 1, the realization, ordinary shareholder salary members account, the preference shareholder salary members account, to close off the books of account of the old or the selling company. Then from there, we're going to make the journal entries for the journal entries to open the books of account of the new company. And finally, we prepare the statement of financial position of the new company. We'll be able to see that by using that particular approach, that question, you should be able to do it within 30 minutes. You have more than 15 marks. You move to the other question. So therefore, you move to this one. to cross off the books of account of the old company. But before you do that, it is important for you to recall what you're told in paragraph 1. The company which is to be restructured is 𝐻𝐿. This is a company which has been making losses, and this is the company which is to be liquidated. Its business operation, assets, and liabilities taken over by a new company, which you're told will be known as 𝐿𝐿 Limited. 𝐿𝐿 Limited. So therefore, this is the selling. In other terms, this is the old company, whereas this is the new. In other terms, we refer to this as what? As the purchasing company. As the purchasing what? A company. So the first thing we need to do basically is to cross off the books of account of 𝐻𝐿. And we do that by preparing the ledger account we are required to prepare as per Roman 1 of that word question. So we move to, or basically we go straight to Roman 1 of the question, and we are required to prepare the relevant ledger account to cross off the books of account of 𝐻𝐿. So part A of the question, ledger account to do what? To cross off books of accounts of who? Of 𝐻𝐿 Limited. So which ledger account do we prepare? The ones which are listed there. The realization account, we are going to start with the realization account. The realization account. Then from there, we will prepare the other ledger account, which is called the ordinary shareholder sundry members account. Ordinary shareholders sundry members account. So we don't have so many entries which we record here. And then from there, Roman 3, we are required to prepare the preference. The preference are shareholders sundry members account. The preference shareholders sundry members account. Yes. So basically, we said what we just need to recall is what we record in each of these accounts. And actually, we said when crossing off the books of account of the old or the selling company, what we do, we go back to the balance sheet, to the statement of financial position of this company, and basically we have to cross off all those particular accounts which had balances and whose balances are shown in the balance sheet or in the statement of financial position. Can we go back to the statement of financial position of this company? The information which we have, or actually the statement of financial position. Now, what we said, we start by crossing off the asset account. You can see under the non-current asset, we have two assets. We have property, plant and equipment, goodwill, and then current asset, we have inventory, trade receivables. Now, we say if you go to the additional information, you'll be able to see somewhere being told, or basically you'll be able to see a note whereby you are told, you are given information about the assets which were transferred to the new company, and those may be assets which were written off. Usually, or in our case, that is in note number 6. Even without reading all the notes, I can see that in note number 6. Can we go to note number 6? We are told the tangible assets were transferred to the new company at the following fair values. Which assets were transferred? They include property, plant and equipment, inventory, trade receivables, and then you're told goodwill was considered valueless and it was written off. So therefore, we go back to the statement of financial position. We have 4 assets, 2 non-current assets and 2 current assets. We know the PPE, inventory and receivables were transferred to the new company, goodwill was written off. Now, what we said, those particular assets which were taken over or transferred to the new company, we debit them here at the book values. The book values are the values we have in the statement of financial position, but it's also important for us to indicate that our values will be in thousands of shillings. So the assets which were transferred to the new company include the PPE. What is the book value for that? Remember, we said we use the book value or the carrying amount. The book value or the carrying amount are the values we have in the statement of financial position. Not the values we have in note number 7. The values we have in note number 7, we are going to use them when opening the books of account of the new company. So that's very important. So the book value for this is 59,500. 59,500. Then below that we have goodwill. Goodwill is an asset which has been written off. We said those assets which are not transferred to the new company and they are written off. Basically, those assets are supposed to be debited in this account, not the realization, but the ordinary shareholder sundry members account. Goodwill was written off as per note number 7. The value for that is 9,000. So then from there, we go to where we have current asset. The two current assets as per note number 6 were transferred to the new company. We debit them here at the book value. The book value are the values we have in the statement of financial position 18.5. And then this one, the trade receivables. The trade receivables is what? Is 14.5. So basically, we are done with the asset. We are done with the asset. So we say don't skip anything, because for the asset can either be transferred to the new company or written off. Those assets which are transferred to the new company, you debit them there at the book value. Those assets which are written off, debit them there at the book value. Then from there we go to the equity. So for the equity, we have the ordinary share capital. Ordinary share capital. Just a minute. Yes, so we continue. So basically, I've said we are done with the assets. We go to where we have equity. So equity, we start with the first item, which is ordinary share capital. Ordinary share capital, we said, is crossed off to this account, and actually should be credited. Ordinary share capital. So ordinary share capital, basically, it should be credited here, and that is basically an amount of 60,000. So then below that, we have 9% cumulative preference share capital. Preference share capital will be crossed off to that account, and equally should be credited in this account. It should be credited in this account. It should be credited in this account. The 9% cumulative preference share capital, and that is an amount of how much? Is an amount of 30,000. Then below that, we have share premium. We said any form of any reserve should be crossed off to this account. Share premium and any other reserve, that one should be crossed off to this account. It should be credited here. Basically, we have 30. And then below that, we have accumulated losses. Accumulated losses is still a reserve, but that one, because it's a negative, it should be recorded on this side. Should be recorded on what? On that side. On that side, the accumulated losses. The accumulated losses. How much are the accumulated losses? 27,400. 27,400, like that. So I hope you can see we are done with the items of equity. Then for the items of liabilities, we have the bank loan and the current liabilities. So we must be given some information in relation to this. In most of the cases, we say liabilities, unless otherwise they are transferred to the new company, we must be given some information in relation to that. Like if you go to note number 7 in our question here, we are told the liabilities are non-current and current. The liabilities were taken over by the new company at their book value. So all the liabilities, the non-current and current, were taken over by the new company. So the liabilities which are transferred to the new company, we say they are credited here. They are credited here. We start with the bank loan. We start with the bank loan. So the bank loan is basically 22,500. And then we have the trade payables. The trade payables, which is basically 59. Then we have the tax payable. The tax payable, which is basically 3,000. We have the bank overdraft. The bank overdraft, which is 40, which is 45, which is 45. Now you can see what we have done. First of all, we have closed off all the accounts which had balances as per the statement of financial position, which is given there. Now, there are two other items I think we said we must always remember to account for here, because the other item which we should compute or basically credit here is the purchase consideration. But I've said don't bother yourself computing that. Ignore that purchase consideration, because if you happen to compute that, you'll consume a lot of time doing this question. It's not a must you have to compute that. You'll be able to get good marks even without computing this. Now, the two items you should always remember to account for is, in all questions for external reconstruction, you'll be told this company which is being restructured had not paid preference dividend for a number of years. So what you need to do, you need to compute the preference dividend in arrears. So this one must be given somewhere in the additional information. You just need to go through those particular additional information. There must be somewhere you're told you're given that information. Where do we have that? I can see it in note number 4. I can see that in note number 4. We are told the preference dividends in Tanga were 3 years in arrears, and the preference shareholders, in fact, we can just ignore that. We just need to know the preference dividends were in arrears for how many years. We are told the preference dividends were 3 years in arrears. That is our interest. The other information is basically for computing the purchase consideration, which you have said we need to ignore. So the preference dividends in arrears, we are told they were 3 years in arrears. How do we compute the preference dividends which were payable by Tanga? We are going to use this information about the preference share capital. The company had issued 9% preference shares, meaning the preference dividend to be paid each year will be 9% of this. That will give us the preference dividend per annum times what? Times 3 years, because they were in arrears for 3 years. Yes, that basically gives us the preference dividend in arrears for how many years? For 3 years. So let's work out this. So we have 9% times 30,000 times 3. And basically we are getting what? We are getting 81. So how do we account for this preference dividend in arrears? The preference dividend in arrears, we say they are debited here in that account, and then we credit them in this account. The preference dividends in what? In arrears. 81. The other item we should also remember to account for is to debit the liquidation cost here. The liquidation cost which was incurred in liquidating this company and paid by the old company should be credited here. You should also be given that in the additional information. Let's go to the additional information number 5. I can see it somewhere in note number 5. And you're told the liquidation expenses of Tanga amounted to 8 million and was basically settled by Elewa. So there was a liquidation cost of 8 million. Now, these are the two additional items you should always to remember to account for, and which are not given in the statement of financial position. Now, once we are done with that, basically in our case, we are done with the part A. Basically, that's what you should do in relation to part A. And now, if that question you leave it at that point, you'll be able to see that you can only maybe lose 1 mark or maybe 2, even if we have not computed the purchase consideration. Because, for example, in terms of how this account is marked, this is now the items which will be marked 1, 2, 3, 4, 5, 6, 7, 8, 9. How many marks are allocated here? The marks allocated here are 8. So the minimum marks you can be allocated. In fact, this is how this account is marked. Any marks allocated here for any 8 at half. Any 8 at half. Any 8 at half. Any 8 ticks. Each tick you get what? Half. It basically means that you need to get 8 ticks here. How many ticks do we have? We already have more than that. 1, 2, 3, 4, 5, 6, 7, 8, 9. So we already have 4 marks there. 4 marks there. Now this one is basically marked like this. Any 4, because the marks are located here at 4. Any 4 at 1. Because I think just 2 items which are missing here, the purchase consideration and the realization gain on loss. So 1, 2, 3, 4. You can also see here, we already have 4 marks. And this account also is marked any 2 at 1. So I can be able to share with you the marking scheme. You can be able to see. So in that case, you can see we already have 2 entries. How many marks are located there? 2 marks. You can see within 10 minutes. Within 10 minutes, you should be having those 10 marks with you. You should be having those 10 marks with you. Now, once we are done with that, we need to move to the other part of the question, and that is part B. So what are we required to do in part B? In part B, basically we are required to make the journal entries to do what? To open books of accounts. Books of accounts of who? Of the new company. Remember, the new company is called what? Elewa Limited. So we are required to make the journal entries to open the books of account of the new company. Remember, you said that if you are required to make the journal entries, now Odiek is asking about. Now remember the other question we did yesterday. Now the double entry for this liquidation cost is debited here, and then the other entry should be in the purchasing company account. Check the other question we did, but you can see we are not required to prepare the purchasing company account. Are we required to prepare that, the purchasing company account? No. So that's why we are not completing that double entry. Sasa? Yes, we are not completing that double entry. But in case it was required, then you have to prepare that and then you credit that amount in that account. Sasa? Yes. So let's make the journal entries. Now, when making the journal entries here, you make journal entries basically for a number of items, which are obvious. So number one, account for the assets which are taken over. Number one, make a journal entry for the assets which are taken over at the fair value. Number two, account for the liabilities. For the liabilities taken over, liabilities are taken over at the book value. Number three, account for the liquidation cost, which was paid. Now, by basically accounting for these three items, you'll be able to score also all the marks here. So account for those three items: asset taken over, liabilities taken over, and the liquidation costs, which were, they don't even bother going through the additional information there, because you can see, we know the assets which were taken over, we know the liabilities which were taken over, we know the liquidation cost which was paid. But maybe you can also peruse through, you see whether there is anything you can account for. For example, I think in note number 8, we can see whether we can make any journal entries here. But basically, let's make a journal entry for those three items. One, we will account for the assets taken over. So we can say assets, instead of giving an addition, we can say what we are accounting for here: an asset taken over, the asset taken over at the fair value. So how do we account for these assets which are taken over? Remember, we are doing a journal entry. We are passing a journal entry. Automatically, once the new company takes over some asset, those assets should be debited in the respective asset account. And then credited in the account called business purchase account at the fair value. So the assets which were taken over by our new company, we have those assets in note number 6. So the assets which were taken over, number one is the PP. So we are going to debit, that one will be debited in the PP account. At an amount of 55. Remember, values here are in thousands of shillings. So we debit PP. Then we the other asset which was taken over is basically inventory. That we debited in the inventory at an amount of 2,200. So then from there we have the other asset which is basically trade receivables, which is an amount of 14,500. Yes, basically I think those are the three assets from what we have here which were taken over. But there is something also you must be able to recall. If you can remember the question which we did yesterday, we said that once these liquidation costs which is incurred by this company